Welcome back. Today's explainer is an absolute must-watch if you follow the markets. We are diving headfirst into a fascinating high-risk, high-reward corner of the financial universe, small-cap stocks. Now, we all know small caps get a massive amount of hype for their explosive growth potential. But today, we're popping the hood. We're going to systematically unpack the deep structural risks that make this specific market segment just so incredibly volatile.
So, here's our game plan for today. First, we'll look at the allure of small caps. Second, we're defining the market tiers. Third, we'll break down the anatomy of high volatility. Fourth, we'll look at the macroeconomic threat. And finally, number 5, the risk versus reward.
All right, let's jump straight into section 1, the allure of small caps. You really can't talk about these smaller companies without acknowledging why we're all so drawn to them in the first place, right? I mean, these are the innovators, the disruptors. They're often in the early stages of their business life cycle, which gives them this massive potential for outsized growth. But all that potential brings up a pretty direct question, one you should probably ask yourself about your own portfolio. Do you know what you actually own? Seriously, when you buy a small cap index fund or you drop some capital on a smaller company, it's so easy to just fixate on that upward trajectory. But do you truly grasp the underlying structural risks and, frankly, the absolute turbulence you might be holding on to? Let's visualize this. Think of large-cap stocks as massive ocean liners. They've got highly diversified revenue streams, they're incredibly stable, and they carry a ton of momentum. But, they're also really slow to turn. Small caps, on the other hand, they're speedboats. They're remarkably agile, they can accelerate instantly, and their growth potential is off the charts. But, and this is a huge but, they are so easily swamped by macroeconomic waves. The exact same waves that a giant ocean liner would just effortlessly slice right through.
Which brings us to section 2, defining the market tiers.
Okay, so we need to get crystal clear on market capitalization. A super common beginner mistake is looking at a high share price and thinking, wow, that must be a massive, stable company. But a $500 share price doesn't automatically mean it's a bigger company than one trading at $50. Actually, market cap is calculated simply by multiplying the current share price by the total number of shares outstanding. That equation right there, that is the true measure of a company's total equity value. And notice just how strictly these tiers are defined by the industry. Up at the very top, you've got your mega caps. These are the behemoths valued at over $200 billion. Below them are the large caps, and then the mid caps. But our focus for this explainer is the small cap tier. This sits right in that sweet spot. Well, volatile spot, between $250 million and $2 billion. And this exact placement on the financial spectrum, it dictates absolutely everything. It changes how these companies get funded, how they're researched, and ultimately, how they trade. Let's get into the mechanics in section 3, anatomy of high volatility. Here is the absolutely crucial takeaway. Volatility in small caps is not random, it is structural. It's built right in. First off, they have a thin share float and low trading volume. That just means a relatively small buy or sell order can violently whip the price around. Second, they really lack institutional buyer stabilization. Think about it. Large caps have massive pension funds just waiting to buy the dip, which creates a nice price floor. Small caps, they don't have that safety net. Third, they suffer from sparse analyst coverage. So when new information comes out, it gets priced in very unevenly. And finally, because of this lack of liquidity, they are highly vulnerable to aggressive short squeezes. And hey, this isn't just anecdotal. There's fascinating academic research published on Archive by Useful Alphas that hits the nail on the head. They note, these stocks have wider bid-ask spreads, lower institutional ownership, and less analyst coverage, all of which allow mispricings to persist. So you see, these structural realities are exactly what allow massive, sudden price movements to thrive in this specific tier. The volatility isn't a glitch. It is baked right into the market structure. Now, let's look at the bigger picture in section 4, the macroeconomic threat. This is where the risk profile really sharpens. See, a mega cap company can just issue low-yield corporate bonds and lock in long-term predictable debt. But small caps, they rely heavily on floating rate debt. It's like a dangerous domino effect. Domino 1, the Federal Reserve hikes interest rates. Domino 2, the cost of that floating rate debt surges immediately for our small cap company. Domino 3, their profit margins get severely compressed, mostly because they just don't have the pricing power to pass those new costs on to consumers. And then the final domino, the share price rapidly drops. Psychologically, this sets off a total herd mentality in the market.
When economic uncertainty starts looming, investors violently prioritize short-term safety over long-term returns. Capital just rushes away from small caps. Everyone flees to the safety and liquidity of large caps. It's literally like a herd of animals turning on a dime the second they sense danger.
This leads us perfectly into Section 5, the risk versus reward.
Let's look at the hard numbers. When we compare the Russell 1000 large caps against the Russell 2000 small caps, the difference is stark. The data clearly shows that the annualized volatility for the small cap index is 2.47 percentage points higher than the large caps. That gap you're looking at, that is the exact mathematical representation of the turbulence we've been unpacking today. But what does that volatility actually feel like in your portfolio? Well, it looks a lot like this. Negative 19.6%. That is the average intra-year drawdown for the small cap market. I really want you to think about that for a second. If you're going to invest in this space, you have to be emotionally and financially prepared to watch nearly a fifth of your investment's value just evaporate over the course of an average year. Now, historically, the old assumption was always that you'd eventually be rewarded for stomaching that kind of volatility. But the recent data tells a pretty sobering story. Small caps actually haven't beaten large caps since 2016. Driven by the immense stability and the sheer dominance of giant tech firms, we are currently living through the longest stretch of relative small cap underperformance on record. So right now, you're taking on significantly more risk, but without that historical return premium. Which leaves us with one final, absolutely vital question to wrap up this explainer. Is the potential for outsized growth truly worth the turbulent ride? Before you go chasing the allure of the next big small cap disruptor, I really want you to use the structured data we just went through to deeply evaluate your own personal risk tolerance. Because in the world of small caps, yes, the speedboats are thrilling, but the waves are very, very real. Thanks so much for learning with me today, and I will see you in the next one.